Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the Darvas Box swing trading strategy. Now, this method is designed to help you identify breakout opportunities in trending markets. You will learn how to spot price consolidations, confirm breakouts, and manage your trade effectively. So stay tuned until the end to understand how to apply this strategy step by step and to avoid common pitfalls. So we start by understanding what the Darvas Box swing strategy is all about, and this is based on identifying price movement within a defined range called boxes. Now, when price break out above the upper boundary of this box, it signals a potential buying opportunity. While if price breaks below this box, the lower boundary of this box, it signals a potential selling opportunity. This strategy emphasizes on volume as key. You know, when you see a breakout accompanied by a high trading volume, it is considered more reliable as it indicates a strong market interest. So the Darvas designed this approach to filter out market noises and focus on clear trends, making it particularly effective in a trending market. So by focusing on price action and volume, this method allows you to identify potential entries and exit points with discipline. So let's see how we can use this Darvas box for swing trading. Now begin by identifying a market or stocks that is trending either to the upside or to the downside. And as you can see, this market at this area is trending to the downside, and we can see that we are in a downtrend. This is a good signal that we are in a downtrend. The fact that price broke this previous low is a sign that we are in a downtrend. Remember, the Darvas strategy works best in a clear directional moving market, not in a range or choppy market. So you have to look for consistent higher highs and higher lows in an uptrend, or lower lows and lower highs in a downtrend. And as we can see, price is creating consistent lower lows, lower highs, lower lows, lower high, lower lows, lower high, lower lows, lower high in this market. Now, once we have identified our trend, you draw your Darvas box by marking out the highest price, which is known as the upper boundary, and the lowest price, which is known as the lower boundary. So at this area, we would mark out the highest point to the lowest point in the market. This would be known as our box. So when we have marked this out, remember that the box has to be a visual range, which is where price is moving sideways before potentially breaking out. Volume also plays a crucial role in confirming the breakout. So you have to pay attention to trading volume when a breakout occurs. And as you can see in this area where there was a breakout, it was broken out by an increased volume. You can see there was an increase in the volume in this area with the breakout. So this will be where you would want to enter your trade when you have seen your volume. You have seen the backing of your volume. Your stop loss just above the upper boundaries, and you aim for your 1:1, or you aim until where you see the volume is reducing or decreasing. This would be an area where you would be expecting to exit your trade. If you look at this area, you would see another Darvas box at this area. This is another example. At this area, when price broke out, it was accompanied by an increased volume. You can see the volume bar here was an increased volume bar, signaling that a lot of orders came in at that area in the market. So this would be a good area to enter your trade, stops just above your upper boundary, and you aim for your take profit region 1:1, 1:2, as the case may be. Remember, risk management is also essential when using this strategy. Remember to always place your stop loss outside the opposite boundary of the box to limit losses. To exit your trade, if price falls back within the box or break out in the opposite direction, you can leave your trade. So when you notice price is going to form another box and it breaks out of the box, you can exit your trade. You can also incorporate trading stop loss or trading stops to lock in profits when the market is trading in your favor. So you have to stay disciplined and follow your steps, which will help you navigate trades effectively and avoid emotional decision making. Now let's look at some common mistakes to avoid. The first mistake is forcing bucks into the stock market. Now, the lack of a clear trend may signal that the market is in a sideways moving market, and this will lead to a lot of false signals. So you need to avoid trading in a range bound market. If you notice that the market is range bound, like in this case, you see the market is range bound, and our strategy would not be effective in this range bound market. So when you notice the market is moving in a sideways direction without a clear trend, you avoid taking the trade. Always ensure the price action shows consistent direction before drawing your box. Another pitfall, another common mistake we make is avoiding or ignoring volume confirmation during a breakout. You must also see a breakout with a significant volume. If not, you might be walking into a false signal. So you have to pay close attention to the volume spikes when price moves beyond your box to validate your breakout. Now let's look at this example. As you can see, at this area, price was trending to the upside in this area, and as you can see, we created a box at this side, we created a box in this area, there was a box in this area. When price decided to break out from the upside in this area, it was not accompanied by a spike in volume, which signifies that it would have been a false breakout. And look at what happened, it broke out to the downside. So you have to pay close attention to your volume spikes. Another mistake we normally make when trading this strategy is failing to set stop loss order. So without stop loss, you are risking holding onto a losing trade. So you have to place your stop loss just outside the opposite boundary of the box to limit your risks. Another common pitfall we need to avoid is over trading. And this is a mistake many traders make when using this strategy. Entering multiple trades simultaneously can also make it difficult to monitor each setup properly. So increasing the likelihood of error, you have to avoid this. Only focus on quality over quantity by selecting only the clearest setup. So before you trade, you look at the pair, you look at the stock you are trading, the one that has the clearest setup should be the one you should focus on. Now, not adjusting stop levels as new box form is also a frequent oversight. Consider using trailing stops along with new boxes to allow you to protect gains while staying in the trade as long as the trend continues. Failing to do this will result to missed opportunities or unnecessary losses. So in this downtrend, as you can see, price form the first box. If we are still in this trade and we do not want to leave the trade, you can incorporate your trading stop to continue, because you can see that price still formed another box in this area, which you would want to also capitalize on, including another box in this area. So this is how to continue to stay disciplined and to capitalize on every market opportunity you see. So avoid these mistakes to stay disciplined and follow the strategy rules closely. This will help you to make more informed decisions and manage your trade effectively. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. And if you found this video helpful, do not forget to like, share and subscribe. Turn on your notification bell so that you will never miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.